Welcome to Understanding Moving Averages. Here you'll find out exactly why we use moving averages, what we do to use them, and how you can do just the same. Essentially, moving averages are very useful for us to have on our chart in trend-based markets only, because not only do they identify where we've got decent speed and momentum in the markets, but they can also objectively identify where trading opportunities lie. Now, you will notice that there are quite a few parallels with the module on cyclicity. However, this just goes to say that there is a lot of overlap in all of the modules in our toolbox, and we tend to use all of them together when arriving at a trading decision, so that there's quite a bit of synergy for us. That's the beauty of it. But what are moving averages? Here is the true definition. I mean, there are two common types of moving averages which we use: the simple moving average, also known as the SMA, and the exponential moving average, or EMA. Now, we're slightly more tilted towards the exponential moving average because the trajectory of the curve is slightly more favored with regards to the most recent price action. But what both moving averages have in common is that they're simply dynamic lines which calculate the mean price over a certain period of time. It could be 20 periods of time, it could be the average mean price over 20 days, i.e. the 20 moving average, or it could be the mean price over 50 days, hence the 50 moving average. But in the example here, if you plotted the 10-period simple moving average on the daily chart, you would simply add up the closing prices for the past 10 days and divide that number by 10, and there you have it. You have the average closing price over the past 10 days. And if you collate these average prices together, you will have a moving average, and that's exactly how they're formed. Very, very straightforward. There are lots of moving average combinations out there, hundreds, thousands. However, what we want to work with is the moving average combination where most people who know what they're doing are actually using as well. Hence our usage of the 20 and the 50 EMAs. So the exponential moving average, very similar, in fact, almost the same to the simple moving average, apart from the one key difference in that EMAs bring more weight to the recent price periods, i.e. days in this case, like I just mentioned. So why do we really want to use moving averages? Well, we use moving averages in trending markets only, really. I don't see the point, and certainly we don't see the point in using them in trend-based markets, because they don't really do anything apart from move sideways. In a range-based market, you'll see a moving average moving just to the side. But what they do in our trending markets when the conditions are right is they give us a very objective measure of the speed and momentum in the market, which is something we'll talk about a little bit later on. And this is exactly what we want. We want objectivity and to establish order within the market of chaotic randomness, which is essentially what the currency markets are, like we've mentioned before. And of course, if we've got moving averages which have been respected, which signify that we've got decent speed and momentum in the market, like for example, it could be the 20 or the 10, then that's a very good sign to us traders. It means that there's a lot of it in the market, i.e. speed and momentum, and it means that we can henceforth realize our profits a lot faster, as we do not want to be in the trade for longer than is necessary. Also, moving averages are valid technical levels, and they are very convenient if, for example, in a trending market, they've been tested before, like price action has, say in a downward trend, rejected the 20 moving average, and it comes back to test the 20 moving average again, then if we get a reversal bar off that, that will give us an opportunity to sell. We'll look at this in a minute on real charts, so you know exactly what I'm discussing here. And they basically provide us with decent milestones as to buying the dips in an upward trend and selling the rallies in a downward trend. And you'll see quite a lot of the time that price action tends to extend and then make a retracement. Then when it gets to a moving average, come back and extend again and go into phase one again. So very convenient turning points a lot of the time. So in this instance here, we have in this example an upward moving average tracking the price action. The price action is moving upwards, the moving average will move upwards. Price action is the leading indicator, and the moving average will always lag to a degree because it is based on the averages of the last 20 days in this instance. If this is the 20 moving average, which it is, and generally the smaller the moving average, the tighter it will track price action. So you'll generally see a bit of distance between the 200 moving average and the price action, less of amount of distance with the 50 moving average and the price action, and quite often price action will come back and test the 10 or the 20 moving average before cycling again, making higher highs and higher lows in an upward trend, or making lower highs and lower lows in a downward trend. So here we could see that it's come to respect the 20 moving average. In this instance here, we get that quite a lot. And of course, like you'll see in the cyclicity module, moving averages respecting the price action are synonymous with decent cyclicity, where we've got decent higher highs and higher lows in an upward trend, making higher peaks and higher troughs, and in a downward trend, lower highs and lower lows, with lower peaks and lower troughs. So the steeper the moving average is facing, or sloped should we say, the better. It essentially means that speed and momentum is higher in favor of the direction where the moving average is pointing. And that's what you want, speed and momentum, in order to perpetuate our position to hitting target in a shorter amount of time as possible. So a steep uptrend, and indeed the subsequently angled moving average, reflects that there is more speed and momentum in the up move, and this is what we want in order for our long position to hit target in the shortest amount of time possible. So again, just like we do with cyclicity, we imagine a clock face, and what we want is our 20 moving average, or most recent moving average, to be facing between 12 and 2 p.m. in an upward trend. If it's facing between 2 and 3, in this instance here, then it's said that the speed and momentum is okay, but it's not quite as good. There's less speed and momentum, which means that we might be in a position which might hit target eventually, although you might have to wait a little bit longer than if the price action and the moving average, which it's respecting, is angled towards 12 and 2 clock face here in the upward trend. So again, we look at the order, angle, and separation of the moving averages. This is important, but it does depend on whether you're going long or short. If we're going long, we want the 20 moving average to be above the 50, and the 50 moving average to be above the 200. The angle, just like we mentioned, we want the most recent EMA, like for example the EMA that price action might be interacting with, in this instance the 20 moving average, to be angled as steeply as possible, preferably between 12 and 2 p.m. 2 and 3 is okay, but it's a sign that there's less momentum in the market, less speed and momentum in the market. And if it's just flat facing 3 p.m., then we might as well not bother. And we'll show you some examples of flat EMAs in a short while. And so separation as well, what it goes to show us is the wider the gap between the moving averages, this is another clue reflecting the market's speed and momentum on the present moment. And we would invite you to cite this example for the ultimate way of looking at moving averages in terms of having the 20 above the 50, the 50 above the 200, higher highs and higher lows, separation, order and angle of the 20 EMA facing between what would otherwise be 12 and 2 p.m. on the clock. And conversely, in a downward trend, when we're looking at moving averages, tracking price action, we want the cyclicity to take the lead, i.e. the price action to take the lead, making lower highs and lower lows, like we could see here, lower peaks and lower troughs, and the moving average, particularly the smaller one, we have what we call time frame correlation across the longer term, medium term, and shorter term bars and sellers. We would have the 20 moving average, which is what is price action is respecting at the moment, below the 50, and the 50 EMA below the 200. That is known as order, angle, and separation, which is something we're going to talk about just now. But before that, we want to just talk about the steeper, just like in the upward trend. The downward trend is just the same. The steeper the gradient, the better it is, because it's reflective of the fact that there's speed and momentum in the market. So if cyclicity, the trend is basically between 4 and 6 p.m. on our clock face here, or indeed the shorter term moving average, like it could be the 20, it could be the 10. I'd say recommend using the 20, quite frankly, the 20 moving average for this. Then if that too is basically between 4 and 6 p.m., that's a very good gauge that we've got speed and momentum. And if we did decide to take a short position off the back of it, that is very likely our trade will hit target in a relatively short amount of time. Whereas if it's just angled between 3 and 4 p.m., it's okay, but the momentum is not there quite so. And if it's facing just at 3 p.m., i.e. sideways, you might as well not take the trade at all, because you could be rest assured that you could be in a position, but it won't actually go anywhere. So order angle and separation, just like with the upward trend, is a great plus, a fantastic plus. So if we consider the moving averages which we use, the 20 exponential moving average, the 50 EMA, and the 200 moving average. Order angle and separation, we're going to drill this into you. It's really important in order to trade with the trend successfully. We want our EMAs to be in descending order. For example, the 20 moving average to be below the 50, the 50 moving average to be below the 200, the angle, of course, if there's slopes in a steep angle between 4 and 6 p.m. in this instance, it's a reflection on the market speed and momentum, which is a good condition for our short opportunity if we're actually in the trade. And of course, last but not least, we have the separation between all moving averages. The wider the separation between the moving averages, the more reflective of speed and momentum it's said to be. And of course, in this hypothetical situation here, this is exactly what we want to wait out for. Lower highs and lower lows on the cyclicity, just like we had on the previous slide. And of course, the moving averages in the right order, reflecting that the longer, medium term and shorter term buyers and sellers are all singing from the same hymn sheet, and that there's speed and momentum in the market. So here, if we look at dollar yen, here's a prime example of a downward trend. Very nice steep angle to it, certainly between 4 and 6 p.m. We've got a very decent order angle and separation between these moving averages. We've got, in terms of the order, okay, 20 below the 50 below the 200, which is exactly what we want if we wanted essentially time frame correlation, i.e. the longer, medium term and shorter term buyers and sellers being singing from the same hymn sheet. Obviously it's bearish. You've also got separation, the difference between both moving averages, all three moving averages, is quite great. So we've also got lower highs and lower lows in terms of the cyclicity here as it trickles down, and respect for the 20 moving average. So these are the kind of conditions we want in a downward trend, are exactly the kind of conditions we want in a downward trend. And certainly with an opportunity like this one here, we're taking this one short. We would have looked for taking this one short as well, because we can see that it's come up, respected the 20 moving average here once before, i.e. here. We've even taken it short here as well. So do you remember what we said about selling the rallies in a downward trend? So here we've got an extension, had the rally here, i.e. the phase 2 retracement. It's come back to a technical level. In this instance, has come back to the 20 moving average, which has been tested before, and it's high tested. You can take advantage of taking it down to previous swing low. Here as well, it's not such a nice setup. However, it is a valid setup. We've got a reversal bar off the 20 moving average, like so, a seller bar. So you can take it short down to the previous swing low, or even a lower low if you wanted to go for a high reward, low probability outcome. It's entirely up to you. And that's just one example at the end. There are better examples out there. So if we move over to pound yen, affectionately known as the twisted sister amongst the few traders out there, and we can see here that it's, well, very exciting really. We've got the moving averages, the 20, 50 and the 200 moving sideways towards 3 o'clock. That is when we know we can use the EMAs as our objective measure, not to do anything in terms of the trend-based trading. If the EMAs aren't angled anywhere, like between 12 and 2, or at least 12 and 3 in our clock face, an upward trend, or an upward movement, or between 3 and 6 p.m. in our downward move, then what's the point? There's nothing there. This is a range-based trade. So what we can do is we can wind the clock and we can simulate this movement happening right there and then. So that you can see it's starting to shake a leg. We're starting to get separation in these moving averages. We've got the 200 above the 50 above the 20, and they're starting to separate out a little bit more. We're starting to get cyclicity forming as well, and respect this instance where it's respected the 20. You remember what I said about the 20 moving average generally being one of the better moving averages for trading the bounce off? Well, we've certainly got it here. And we've got it here, although, okay, this high test you could have seen as a break of support now testing as resistance, although you could be forgiven for wanting to wait a little bit longer for an actual trend to form because it's not that clear yet. We know full well at this point here that the 20 moving average is respected, and as we have seen on these two occasions here, and we're starting to make lower highs and lower lows. So based on that, we can see what's going to happen next, potentially, based on this criteria. And you can see, apart from this news-related spike here, we've got very good cyclicity, making clear lower highs and lower lows, decent movement, like, for example, here. The new spike is generally seen as an anomaly, certainly on the daily chart. For the most part, we're still making lower highs and lower lows. We've got a really nice high test. It's still respected the 20, as it has done here and here. So you can be inclined to take it short at this point here and target the previous swing low. And we've got an inside bar, so we take it short again. And finally, it hits target after a while. So you can see how the high probability trades occur in a trending market where we've got decent order angled separation. I know we had a bit of an anomaly here, just to throw you, but these news related spikes, these kind of freak end of the world events, don't let them trouble you too much. In this instance, if you wanted to go and target a new lower low, because we are making lower highs and lower lows based on cyclicity, you could have. However, you'd be rewarded quite handsomely. You can see how it's come back to the 20 moving average here, respected it, had a high test followed by a doji bar, which is a sign of indecision, then we come back to hit target yet again. So you can see how well the 20 generally fares, especially when price action interacts with it, and we've got order angled separation. The 20 to below the 50 EMA below the 200. We've got a decent distance between the EMAs, and they're steeped in a direction where we're looking to trade, in this case, in a down direction. Again with dollar CAD, we have a nice downward trend, lower highs and lower lows, a decent amount of predictability about it. We've got the 20 moving average below the 50, the 50 moving average below the 200. Okay, moving averages do lag, but you can see how they objectively map out how we can expect cyclicity to react next. So for example, we could see that, all right, it doesn't respect the 20 moving average, however, it does seem to like the 50 a little bit more. So what we could reasonably expect is cyclicity to come back to the 50 moving average, make a lower high before it makes a lower low again. Here we've got pound New Zealand, we've got the moving averages here starting to separate out. We've got good order, 20 to below the 50, 50 below the 200, and we're starting to get a decent run to the downside. Got a high test bar here, great. Looks like we've got a fantastic opportunity to sell. Hit target, make a lower low, and we come back to the 20 moving average, have a whiplash rejection, and make a lower low again. And then it just runs away. That's why we wait for a reversal bar, by the way, on the moving average, just to give us a cautious entry into the trade. So we wouldn't enter this one because it closed above the 20 moving average, and we'd want some kind of high test bar or a doji bar, but we didn't get it, and it saved us this horrific move upwards and being the wrong side of that one. That's what we call an end of the world event, when you have something quite grand in the scheme of things, which sends our trade the other way. But nobody can see it coming. And conversely, in an upward trend, we're looking at euro dollar here, in a golden bygone era here. We've got in an upward trend, a moment order angle and separation is just right. We've got a very nice steep upward move, higher highs and higher lows, decent cyclicity here. The 20 is nicely extended above the 50 moving average. The 50 is above the 200. We've got a decent separation between the both, and certainly the 20 and as a bonus, the 50 are pointing between 12 and 2 p.m., making higher highs and higher lows. So we can see that it's respected the 20 moving average like so. So we could reasonably expect it to make a higher high, come back to the 20 moving average like it has, make another higher high again. Here's an example of gold, which is a currency on its own. We have an upward trend, higher highs and higher lows. We've got great order, angle, and separation here. We've got the 20 moving average above the 50, the 50 moving average above the 200. We've got a great separation between the two. That's a sure sign that it's bullish. We've got it angled between 12 and 2 p.m. And sure enough, we're just now looking for dips to buy. But will it actually come back to retrace? We'll soon find out. Whoop, that looks like a potential opportunity. A low test bar of the 20 moving average, looking at higher highs and higher lows. Do we take that? Do we have any other technical reasons to get onto that one? Not really, but if we did have another technical reason to get into this one, we sure will do. Take the break of the high. Use the Fibonacci just to see if we've got a Fibonacci number. 0.382, shallow retracement. So you could put an order above the high, stop loss below the low here. That is an idea. But we haven't really got an instance whereby we've had the 20 moving average respected last time. Here it wasn't respected, it's rejected it here. As in closed below it. So nullified it. So if the 20 moving average holds here and it makes a higher high, then comes back again and respects the 20 moving average, that's when we know we can take it. But an instance here, in terms of trading opportunities and the conditions, with moving averages, these are very good conditions here. So that's it on how to use moving averages. We wish you well. See you on the next module.